All right, so Jay, I want to switch gears here a bit because your next largest fund by AUM, at just under 400 million, is your MLP ETF, ticker AMZA. Now, something interesting going on here is that MLPs are associated with oil, and oil is closing out its third monthly loss in a row. But you say MLPs are now only 20% correlated with oil prices. Can you explain that a little bit?
Yeah, so fortunately, because it was pretty stressful running that fund over the last 10 years, that's one of the first actively managed funds that we launched. But unfortunately, we launched it at a very terrible time for MLPs. But what's happened is that the companies have delevered, have much higher coverage of dividends, and also, probably most importantly, to respond to your question, have a big leverage to natural gas. The export of natural gas is extraordinarily compelling. In the U.S., natural gas trades for about the oil equivalent of $12 a barrel on a BTU basis, whereas it trades pretty close to oil, which is obviously in the low 70s. So that arbitrage is so enormous. It's driving flows down to the Gulf and exports. And some MLPs, like Cheniere, have actually operate the export terminals. So that growth story has sort of overwhelmed the fact that oil and refined products people aren't as bullish about, and really started to drive performance. Plus, retail investors got way too negative about MLPs, particularly after the pandemic. So they've been absolutely crushing it for the last really since the pandemic.
And Jay, one of the big themes in the energy space this year has been M&A activity. We've seen a lot of that concentrated in the upstream. We have seen some of the pipeline companies consolidate, but given how difficult it is to build new infrastructure, particularly from state to state, is that, as consolidation looking ahead, is that a catalyst at all for the industry?
Absolutely, and it's a good demonstration of what I was asserting, which is MLPs are mostly driven by retail investors who want to get tax-deferred income because you get tax shelter from the depreciation that gets passed through in the partnership return. And so because it was so retail-focused and they got kind of burned and didn't fully understand it, got way too cheap. So major corporations have been buying up MLPs, and they've really created a shortage of opportunities. And I know so if you look at like AMLPs, one of our competitors, when something gets bought out, like they have to buy all the other constituents that are all MLPs, and it drives their price higher. So there's a developing shortage of MLP equity, but investors who own them want more of them because it's one of the few ways you can get fully tax deferred income most of the time.
And sticking with that, Todd, AMZA is in the middle of the pack this year in terms of performance, and its larger competitor, the Alerian MLP fund, is at the back of the pack. So is size a factor here? Is it any type of hindrance?
I don't think that's the case. So again, for full disclosure, I work for the company that is the index provider behind the Alerian MLP ETF. I want to broaden this out into why MLPs make sense. Energy is the worst performing sector, I believe, in the S&P 500. MLPs are not part of the S&P 500, so you can get great exposure to large cap companies that are high quality, free cash flow, dividend paying companies through ETFs like AMLP and some of its peers. So this is a great strategy, great to add to your overall broadly diversified portfolio, and you likely don't have any exposure to MLPs if you own just a core S&P 500 index-based strategy.
All right, and Jay, you said that you think looking ahead, value could outperform growth. What about small caps? Because they've outperformed in Q3. Does that trade have more room to run looking ahead?
We think they do. And the one thing that's never really discussed publicly is that a lot of the reason they'll outperform is not because they borrowed too much and have too much floating rate. It's just the sector. It's not only that it is partly that, but the sector allocation in the small cap index is much less tech focused. It does have a lot of financials, a lot of REITs, which will do well when rates drop. So a lot of strategists go on your channel and say, oh, well, they don't like small caps because the economy is going to be weak or something like that. But what you're really saying then is you don't like financials, you don't like REITs, you don't like some of these beaten down stocks, because that's really the primary driver of that return. They are also cheaper than their large cap components in the same sector. So you're getting kind of a double discount. You're getting the value stocks, but even cheaper than the large cap value stocks.
All right, and finally, Q4 kicks off tomorrow, so got to ask, top trends to watch. Todd, what is on your radar as we enter Q4?
Well, we could have a record year for ETFs flows. We are on pace to cross the $900 billion net inflows, given where we are thus far. Just above that was the record a couple of years ago. So we're excited. The ETF industry continues to gain ground. We already have a record for fixed income flows with 3 months to go. We'll see if we can get there from an overall asset category standpoint. It's a great time to be following the ETF industry.
All right, record year for ETF flows. And Jay, what about you? What are you watching as Q4 gets underway?
We would definitely focus on the financials. We think the rally in financials is going to broaden out. So we've been bullish on some of the big investment banks like Goldman Sachs and a little bit cautious about the regional banks. But now the regional banks are turning the corner on net interest margin. So we would look to that sector to see if we're correct about these riskier, more cyclical companies like financials and REITs doing better than the more conservative of staples and drugs and utilities.